This show has never been solely about investments. We've talked about anything that affected people and their money. And my guests have included some of the most powerful persons in the world. Business leaders who ran for president, present and future cabinet officials, world-class economists, and the two men who have been chairman of the Federal Reserve Board for more than 2 decades.
First thing we've got to do is realize that the market is only liquid if the individual investor is in the market. Now then, a lot of people that used to think he's a nuisance would love to see him down there today. The big institution was very attractive. He's still attractive, but he must have a small investor too. He's essential to provide liquidity in the market.
The price of oil today bears no relationship to economic reality. Bears no relationship to the production cost of oil, to the cost of alternative sources of energy. It was a political decision on the part of a cartel to quadruple the price of oil arbitrarily because they control 67% of the world's proven reserves.
Paul, let's turn to the rest of the economy. You said earlier this year that you would be mightily concerned if the deficit in the federal budget went over $80 billion. According to Congress's reckoning this week, it's likely to top $72 billion. How concerned are you? Is this likely to destroy our recovery from recession?
Well, I think it's big. I don't think it's going to destroy the recovery from the recession. The trouble with these deficits is not so much the size of the deficit today, when there's a lot of unutilized capacity in the economy, but are we on a course that carries us continuing along with these kinds of deficits as the economy does recover? And the economy has begun to recover. It's been recovering rather vigorously for some months. And it's certainly time looking ahead to begin seeing reducing that deficit. And I would remain very disturbed if those deficits don't get reduced as we move ahead and as the economy moves ahead.
We have to balance our social aims and desires against our investment needs. The more you spend in the social area, the less you'll have to spend in investment. Investment means jobs, and you're going to have to watch your trade-off here. The more you go for one, the less you'll have in the other. And the only way you can make it up for your social aims is to have the government of the United States spend the money. And therein lies the problem. If the government decides to come into the capital markets in a large way, there's less capital available for everyone else. If the government cuts back on its desires, there will be enough capital to go around.
Seems to me you're suggesting that we are going to go a little bit downhill in this world. Is that correct?
I think so, yes. I think that when you begin to look at the world of the 1990s, I think the United States comes down a notch or two.
Will we live worse or just live not as relatively better?
I think not as relatively better. Look, you know, there's a lot of talk about the United States losing its sort of per capita income leadership in the world. But the real issue is that the average American household has got the best homes in the world, it's got the best sets of appliances, the best telecommunications. The average American still lives far better than the average anything else. The trouble is that the gap, which used to be huge, is now beginning to narrow. It's going to narrow further.
Milton, we only have about a minute left. Let's see if we can hopscotch a little bit. Should we abolish the Federal Reserve Board?
Yes.
What would you replace it with?
A computer.
And what would you tell the computer to do?
I would tell the computer to see to it that the money supply goes up at exactly 2% per year, or as close there to as it can manage, on a week-by-week, month-by-month, year-by-year basis.
Is there any form of government regulation that you favor?
Absolutely. There are many forms. I favor the form of government regulation which says that if you murder your wife, you go to jail. I favor the form of government regulation which says you have to drive on the right side of the road.
Ken, you've never lost faith in the power of government to cure economic ills, but most of the country apparently has. How do you explain that?
Oh, there's no doubt about that, Lou. My generation is responsible through the Keynesian revolution, the welfare revolution. A great many Americans, a majority of Americans, have become comfortable, happy, and inevitably conservative, at least those that vote.
Malcolm, welcome. We're just delighted to have you with us.
Oh, it's a pleasure.
Please.
After that build-up, I'm a little trepidatious.
Don't you be trepidatious. I know you're intimidated, but take it easy. You may have a career if you do well tonight. Malcolm Forbes is often called the happy capitalist, and one look just now will tell you why. In addition to his notable holdings, he's the chairman, he's the editor-in-chief as well of Forbes, a business magazine founded in 1917 by his father, a Scottish immigrant. It's now one of the largest and most respected in the field. Malcolm, you were born rich, you've become a heck of a lot richer, but most of the public attention, as I already suggested, is centered on the way you've spent all that money. Now, your father, they tell me, was a pretty tight Scot. How would he feel about all this publicity?
Well, I'm sure he wouldn't mind the publicity. It's the price that would bother him.
Was he stingy in expenditures? Was that your household atmosphere?
No, he wasn't stingy. He was stingy in non-essential expenditures, of which he considered over-generous allowances in that category. I remember whenever we left the living room to go into dinner, we were all taught to turn out the lights on the way into the dining room. He wasn't stingy, he just had a great respect for money, and I've developed a great affection for it.
Well, what is your attitude toward money?
That it's a very nice thing to have.
Well, parts of your book read eerily like a script for what's been happening in Europe this month. For example, you wrote presciently, and I quote, "A common currency will be the final step in a completely integrated market, and the European economic community has moved toward this eventuality. But this surrender of sovereignty touches the very heart of the nation state. To lose control of the right to issue currency is an attack against one of sovereignty's most valued rights." What should we expect next in this European currency crisis?
Well, I think it was almost inevitable, Lou, that what happened last week was going to happen. Once you have disparate economies and disparate nation states, and a market as big as we now have, fixed exchange rates are an artifact of the past. The float is the only thing that will act as a shock absorber between disparate national policies.
We Americans are notorious for our short memory spans, but you and I have been around for a while. Can you recall any time when raising taxes actually reduced a deficit?
I think you're going to see this time, with what we lock in the way of this program, a very material reduction in that deficit, and I haven't seen that in a long time. And I'll tell you who reacts to it. The bond market has. They believe it. You're seeing almost 100 basis points drop in interest rates, and that is a substantial stimulus to this economy.
There's no question that the bond market has endorsed what's going on in the economy, but isn't it a bit weird for a Democratic president to be finding his chief support in the bond market?
I think it's delightful.
In October 1982, a then camera-shy money manager from Boston made his television debut. His mutual fund had the